Himsandhers stock has exploded over 300% in the last year, leaving giants like Pfizer, CVS and Teladoc in the dust. But is this surge fueled by genuine potential, and is Hims carving out a real, lasting piece of the massive $4 trillion US healthcare landscape? In this video, I'll cut through the noise to reveal my fair value price to see if the stock is priced at a discount or a premium versus its current share price of roughly $52 US. Plus, I'll give my buy, sell or hold recommendation and a final star rating of the stock as well. And I'll break it down in 4 key sections, starting with a quick look at what Himsandhers actually does as a company. So yeah, let's dive in. Let's start off with a brief snapshot of Himsandhers over the past year. We can see revenue and EBITDA is up. We can see an EBITDA margin that is positive at 5%. And of course, the share price has risen by over 300%. And the company is headquartered in San Francisco in the United States. So Himsandhers is a direct-to-consumer digital health company delivering prescription wellness and personal care directly to your doorstep. Starting with men's health staples, they've rapidly expanded into skincare, mental health and even primary care. And today, the company not only focuses on men's health, but also on women's health as well, hence why the company expanded the name from Hims to Himsandhers. Their model is streamlined. Online consultations, swift prescriptions, and their own branded products shipped directly to your home. And they're aiming to build a recognizable health brand tailored for millennials and Gen Z. And that's a fresh approach in this sector. So let's go through the bull case first, and here I have a few points. The first is digital disruption, bringing healthcare convenience to a younger demographic, shaking up traditional models. The company also has a strong brand connection, building an approachable brand around previously sensitive health needs, and also recurring revenue engine. The company is scaling subscriptions, offering a predictable growth potential. Now, we have a few points for the bear case as well. We have intensifying competition in telehealth, which could squeeze profits in the future. We also have regulatory risks. Evolving online prescription rules pose potential challenges as well. And then we have customer acquisition costs. Sustainable growth might require escalating marketing spend. And lastly, we have retention hurdles. Keeping customers engaged in a low barrier market is crucial, but also quite hard. So now we've talked about what the company actually does, and we've quickly gone through the bull and the bear case as well. Let's move on to the second part and look back in time and see how has the company performed from a financial point of view in the past 5 years. And we will do that by looking at a few key charts, starting off with the core financial performance of the company. And here we can see a few things. We can see revenue has grown consistently each year by on average 77% per year, and that's massive growth, right, for a company. At the same time, EBITDA has finally turned positive in 2024. The company has an EBITDA margin of 5.4%, which are making investors very excited. Let's move on to the debt sustainability within the company and see if that is any risk for investors right now. And clearly we can see that's no risk at all, right? We can see debt in purple is quite small relative to the excess cash within the company, showing us that debt is really no risk for investors going into the stock today. Another interesting chart that we could look at is the enterprise value performance of the company. Now, the enterprise value is the market cap plus any debt minus any excess cash. So it's kind of a refined market cap of the company. And we can see, yeah, it has run up quite quickly in 2024, right, as the stock price has gone up. And we can see that it has grown at 97% per year on average, which is massive. As we later on will estimate the future cash flows within the company, let's look at some free cash flow data as well. And here we can see the same story as we saw with EBITDA, right? We can see consistent revenue performance. And finally, the company has become free cash flow performance in 2024, showing investors that yes, this is now a profitable company. And the same story continues when we look at the free cash flow performance on a per share basis. We can see negative numbers all the way up to 2023, and then in 2024 we finally have positive free cash flow per share. And this is also reflected on the free cash flow yield, which shows us how much free cash flow we get relative to the share price. Now, these numbers have been negative, but finally in 2024 we have a positive free cash flow yield of 2%. Now, the final chart I would like to show you kind of worries me a bit about this company, and I'll show you why. Now, the worrying bit has to do with the number of shares within the company. We saw 190 million shares issued within the company, and today we're at 221 million, right? So the company continues to dilute shareholders by issuing new shares, which could hurt the investment thesis going forward. Now, having gone through the historical data in the company, let's give the company also two price targets before we move on to the final valuation in the next part of this video. So let's start off with our enterprise value price target, and I'll guide you through all of the assumptions I have behind this. First of all, I'm assuming 20% on average of revenue growth in the coming 10 years. That's lower than 77% we've seen per year in the past 5 years. I think 20% is still quite conservative. We're trying to stay conservative in our estimates. I'm also assuming, however, a much higher EBITDA margin of 15% in 2034. That's higher than the 5% we have today, which is in line with high growth companies. They become profitable with time. I'm also assuming an enterprise value EBITDA multiple of 30 times. Now that's much lower than the 63 times we have today, but that's in line with lower growth, higher profitability, as we see with companies becoming much more mature. Now, with these assumptions, we get a price target in 2034 of $159 versus the current share price of $52. Now, let's move on to the second price target here as well, having to do with the free cash flow. And here are my assumptions. I'm assuming free cash flow growth of 23% per year on average. That's slightly higher than the revenue growth, right? Because the company is becoming much more profitable. I'm also assuming a long-term free cash flow yield of 3%. That's higher than the 2% today, also in line with higher profitability and a lower valuation for the company. Finally, I'm also assuming a average share dilution of 2% per year. Now that's half than the 4% we've seen in the past 5 years, assuming that as the company becomes much more profitable, it doesn't have to dilute its shareholders at the same rate. Now, with all of those assumptions, we get a free cash flow price target in 2034 of $129. Now, as we have two price targets, right, let's just weigh them equally, and then we get a weighted price target of $144 per share in 2034. Okay, so now we're going through some historical data of the company, and we've given the company as well a weighted price target. Let's move on to what everyone wants to see, which is the stock valuation. See, is this a company we would like to buy today, or should we stay away from it? Right, with all of the assumptions I discussed previously about free cash flow, and if we discount them to a present value of today, we get a fair share price for himsandhers stock of $54.3. And that's a discount of 4% versus its current share price. And this also implies an annual estimated compounded return of 15% per year. And to me, this is quite shocking, looking at how the stock has gone up in price in the past year, seeing that the fair share price is actually not too far away from the current share price of the stock. We can see that the company is kind of fairly valued today, at least based on my estimates. Also to point out is that the 15% return isn't really that good if you think about it. We're assuming that revenue and free cash flow will grow at least or higher than 20% per year. And for us as investors, getting a lower return than what the company is growing at isn't that good, at least on a risk-adjusted basis. In these cases where a huge amount of the share value lies in future growth of the company, I would like to see at least a higher annual return than what the company is growing at, assuming higher profitability as well. And before moving on to my final recommendation, here you can see my detailed estimates, at least in terms of growth rates. I'm assuming revenue to grow consistently in the coming 10 years, as I'm also assuming for free cash flow to also grow. The interesting take here is that the growth rate for free cash flow is slightly higher than the revenue growth rate all the way up to 2030, assuming that the company will become much more profitable in the coming years. And here we have a complete summary of the investment. In red, negative, of course you have to buy the stock today, right? Invest in the company. Then you get free cash flows distributed to you each year as an investor. This could be by stock gains, buybacks, dividends, or what have you. And then you have to sell the stock in 2034. You get some free cash flow as well on top of that, right? And that's where the price target we got previously comes into play. And then we can see in blue, right, the total stock gains we get by investing in himsandhers. Now, with all of that said, my final recommendation, now this is not financial advice, is a hold for this stock at this current moment, and the final star rating I've given the company 3.5 out of 5 stars. So looking at my detailed rating of himsandhers stock, we can see that the company has received really good scores for revenue growth, EBITDA growth, and free cash flow growth as well. And also, the company has basically zero debt, right? So that's another great score for the company. Where it hasn't scored that well has to do with consistent stock performance. It's a quite volatile stock, right? But if you can stomach that volatility, I guess that's not relevant for you. But for me, I would like to seek stocks that perform well, but also don't expose me and my portfolio to high levels of volatility. You can also see that the company has scored well in terms of its annual expected return at 15%. That's higher than the average market return of 8 to 10%. But I wouldn't say it's well priced versus its fair share price. It's fairly priced. It's not that attractive in terms of a discount versus its fair share price. Now, I would also say that this company does not have an extreme advantage in terms of competitive positioning. Yes, it has a strong brand, a fantastic business model, but still there are competitors out there, right, that are competing with them at a high degree. And if you are really interested in investing in this company, here in the table below, you can see what happens to the annual expected compounded return if the stock goes down in price, which is good, that's in green, or if the stock continues to go up in price, which is red, which shows us we get a lower return. I would say this company becomes much more attractive when we get the return of 20 or 23% per year, as that's in line with the revenue and free cash flow growth that we're estimating. Now, this would imply the stock to go down by roughly 30 or 40%. I don't think that's very likely, but you never know, right? Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down to the link in the description below, you get the free one-pager, which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you, and I'll see you in the next one.